Acha ji, Assalamu alaikum everyone. Bismillahirrahmanirrahim. This is Yasir Yamin, your ACCA SBI tutor, and today we are going to study about some of the current issues that may be tested in your March 2022 or June 2022 examination. Overall, this video will certainly enhance your confidence about certain aspects of accounting and financial reporting. So definitely do watch this video till the end and get some more knowledge about the related current affairs that are going on. The first area that we are going to touch upon is about taking a deep perspective of the current digital assets and cryptocurrencies that are prevailing at today's time. I often see that often students are pretty much confused about cryptocurrencies and digital assets. Some people take a religious perspective, some people think about it in a halal or haram manner. Some people don't actually know nothing about these type of assets. Some people have done a bit of their homework. I have seen students who actually do trading within cryptocurrencies but are actually unaware of the accounting consequences of dealing within cryptocurrencies. So this video is primarily going to focus on the accounting aspects of dealing within cryptocurrency as a holder or a seller. Now, as a disclaimer, I would want to say that you should keep this in mind that I'm not being an expert of cryptocurrency here. My main focus would be on the accounting implications that your examiner may examine from you or may have examined from you. I'm going to look on these digital assets from an accounting point of view, not from a dealing point of view. So don't expect me to actually tell you how to make a profit or how to avoid a loss by dealing in cryptocurrencies. This is not a trading video altogether. So starting off, we are going to talk about cryptocurrencies, and I would rather like you to focus on the word digital assets, which means we are not only going to talk about cryptocurrencies in particular, but all other digital type of currencies or all other digital type of assets that are prevailing right now. So taking an example, for example, we are talking about digital assets, and if you talk about cryptocurrency being a digital asset, what do you know about cryptocurrency? Before we go on to study the accounting implications that cryptocurrency can have, we need to have a certain little bit of understanding what a cryptocurrency, or as an example of a digital asset, what is a cryptocurrency? How does it work, by the way? So there are some key characteristics, or there are some underlying definitions that you need to learn about cryptocurrencies. The first thing, it is a digital currency, which means it is not actually present in tangible or physical form. When you talk about a dollar or a euro, you certainly think of a currency note that is in your hand and you can trade it for goods or services. You generally think of that. But with the advent of latest technology coming into the market and becoming cheaper day by day, we see now digital currencies, meaning it is a means on some places it is a means of it is a medium of exchange, but it is in digital form. It is a digital currency and sometimes known as a coin, or maybe sometimes known as a token. You see, coin and token are interchangeable words when you talk about cryptocurrencies or other digital assets. So in an examination question, you don't get confused if you see a token, not a coin written. It is a digital currency, it is a coin, it is a token, which is actually based on a blockchain technology. Now, you don't need to know much about blockchain technology, so to say, but just to cover it up, blockchain technology is a digital program which is based on a certain algorithm, and this algorithm ensures that all transactions put onto this program actually correspond between users. So for example, you put in a transaction on the blockchain technology on that particular program. If you put in a transaction that has to be corresponded by another transaction by another person. So the whole technology is based on a balance. The blockchain technology ensures that it does not get corrupt. It ensures that everything remains documented. It ensures that both the transaction executor and the holder of the coin or the token, the ultimate holder of the coin or the token, remain anonymous. So it ensures transparency with respect to the transaction, but at the same time the buyer and the seller, the doers of the transactions, remain anonymous. So basically you can say that blockchain technology is a program. It is an IT program which runs on a certain level of coding, which ensures that all transactions balance. For example, if there is a debit, there should be a credit, and it maintains an accurate ledger. It is uncorruptible to date. So a digital currency which actually runs on this blockchain technology program, which may be in the form of a coin or a token, is basically cryptocurrency. So you can name certain cryptocurrencies which are available in the market with different names. You can say, for example, Bitcoin is a cryptocurrency. For example, Ethereum is a cryptocurrency, and maybe you can name 1,000 more. You may be knowing better than me. There are various cryptocurrencies or digital currencies, as you may say, available in the market. Now, this is the same thing as with any other currency. For example, there are many nations on globally in the world, and you see, for every different country there is a different currency. For example, in Pakistan we have PKR. For example, in Europe you have euros, or for example in England now you have pounds. For example, in US you have US dollars. In Australia you have Australian dollars. So every nation, so to say, issue their own currency. Likewise, it is a blockchain technology is a program in which there are certain issuers. Just like in a global economy, there are certain nations which issue a particular currency. In a blockchain technology, globally, there are certain issuers, there are certain investors, there are certain platforms of, or maybe you can say there are certain software companies which actually issue a digital currency over that platform. And since there are different nations or different issuers of currencies, different type of currencies would be available on this particular platform, right? So different type of currencies you can get. These currencies are traded on an exchange which is actually a digital platform. So physical presence is not available. It is purely intangible. So since it is a digital currency, it is only available on a digital platform. So what do you actually mean by a digital platform? What do you mean by a platform? If I take you to another of my definition, you see what is a platform. A platform is basically a software that provides you the utility or the service, that provides its users the utility or the service of the software. It actually facilitates the users of the software to to use that software to trade in currencies. You can actually buy a particular coin from a particular platform. You can actually sell your coin or token through that platform. So you see, I would say there is a certain website, and that website would act as a platform. And there may be two anonymous person. One person may be in Pakistan, and one person may be in, for example, in US. And these two person, if they hold a coin, they can actually trade this particular coin to US through this platform. Or for example, a Pakistani person can come and buy a particular coin from this platform. So this platform basically acts as an exchange, as a digital exchange, where you can buy and sell different type of tokens and different type of digital assets and digital currencies. So a platform has a good importance overall. So there is for example, there is a seller of the coin, right? There is a platform that enables such transaction, and then there may be a buyer of the coin. right? So there are various parties involved in such type of transaction. The other thing that you need to know about such cryptocurrencies, or you say what I'm talking about, digital assets, these digital assets are not regulated. So that is, they are independent of the central bank. Right now, since it, there are various platforms that allow you to exchange your coins or tokens, or these are just digital assets. These are not owned by a particular nation, so to say, a particular state bank, so to say. So it is an unregulated form of currency that we are talking about. This type of currency does not have legal tender. It does not have legal tender. Legal tender means that, it does not have, to date, it does not have, from any particular nation's central bank, it does not have a legal authority to be used as a medium of exchange. It does. Digital currencies till date don't have any legal value. So for example, if you see a £100 currency note, you would say that this currency, that, this piece of paper, you would say, is valued, it is just a piece of paper, but you would say that it is valued £100, because, the government or the central bank gives that particular currency note the power or the legal valuation of the, of £100. So in a typical traditional currency, legal tender is very important. If on a piece of paper your central bank writes £10, so it is valued at £10. If in a particular country your central bank writes on a piece of paper that it is valued £100, then it is £100, because it is given value by law. It is given value by the central bank of your country, and that is known, and that thing is known as, having a legal tender. Okay. So right now, digital currencies don't have legal tender. So you must be wondering that, then how are cryptocurrencies or other digital assets actually valued? If they don't have, if they don't have legal tender, then how come they would have a certain dollar or a pound or a Pakistani rupee value? How does that happen? And then we'll see it later on how that actually happens, and what does value of a digital asset actually rely upon. We'll see that in a while. So one more thing that you actually that you also need to know is that, these coins are often issued, or I would say these coins or these digital assets are often mined, issued, or I would say in layman language, created by some IT colleagues or IT people. These are digital assets, right? So these digital assets need to be coded off. So, some software houses or some companies actually code these digital currencies and then issue them on a platform. So these currencies are issued by someone. And generally the platforms issue their own currency. They issue with actually partnering with many coders and many IT other companies. They actually, these platforms issue a particular currency. So you need to know, if a platform actually issues a new currency, say a new currency is issued with the name of YY. When a platform issues a particular digital currency, generally this type of digital currency, or you would say a coin, would not provide the buyer with ownership interests. So for example, if I am a platform, you say, YY.com is a platform, and for example, I issue a digital currency named YY1, and you buy this particular digital currency. Just because you are buying a particular security issued from my side, that doesn't actually mean that you would have ownership in my particular company. So cryptocurrencies, cryptocurrencies or other digital assets of these sort generally do not guarantee an ownership. This is pretty much contrary to dealing with shares. You see, nowadays what happens with shares, for example, I'm a person, I go on a digital website, which may be Pakistan Stock Exchange's website. I go on this particular website. I buy a particular share. A share is basically a digital asset nowadays. But when I do buy that share, I get the ownership rights in a particular company. Ownership rights in a particular company, right? But although cryptocurrencies may sound similar, that a particular exchange actually offers these coins on a digital platform, just like how we deal with in shares nowadays. But you need to make it very clear within your mind that generally, these securities or these digital currencies do not provide you with ownership interest, right? So yeah, when you buy this coin, when you buy this particular YY coin, most likely the biggest advantage that you would have is that you can sell off this currency later on to another person when this YY1 currency has more value. So you would buy it right now when I'm issuing, and most likely later on during the later during the period, or maybe after 1 year, 2 year, 3 year, or maybe after 3 days, you most likely would be selling this particular type of digital asset to another person and making some money out of it. So no ownership interest in the issuer. It just has some trade value. And why does it have trade value? I'll just come to that in a bit. Okay. So when the platform actually issues, or when any company actually issues, first time issues a particular type of currency on a particular type of exchange, that thing is known as initial coin offering. Just like you must have heard about initial public offerings, IPOs. So IPOs actually mean that when a company issues new securities or new shares on the stock exchange website, it is known as initial public offering. And similarly, when a particular IT company or a particular exchange or a particular platform actually issues a new type of currency, which it has coded and created, that new issue is known as initial coin offering. So initial coin offering is when tokens are issued to investors. At this time, the issuer may provide tokens. Sometimes initial coin offering involves giving outright tokens to the investors, to the persons that are actually buying that tokens. Or sometimes it also can happen that they provide a promise to provide tokens at a certain date in future. So here comes the innovation. What a particular person can do is that they can actually launch YY1 promise coins in advance. So for example, many of you would know or can know, if you do a bit of research, when you actually code or mine or create these digital coins, these digital currencies, it requires a lot of electricity consumption, right? So for example, say there is a person named YY. He is an IT geek. He is an IT person. He knows how to code and create a new digital currency, which can actually in future act as a medium of exchange when these physical currency notes actually expire. He is very much optimistic about the about the scope of digital currencies in future. He knows how to code it, but he doesn't have the means to actually give consume so much of electricity and mine actually a digital currency. So what he can do is actually he can, in an ICO, in an initial coin offering, he can raise money from the market, from those people who are willing to invest in his ideas. And in exchange, he would promise that as soon as with your money I'm done with coding, I can give you the digital currencies or the tokens, and you would be the first one having these type of digital dollars or digital currencies. And so it actually brings value to you. So now you must be wondering that why an investor who may be unaware of me would give me money for tokens that I will provide in future. These are not yet created. So why would they give me money? Why would they take such a bet? You see, so initial coin offering normally involves actually issuing a real coin. A promise of issuing a coin in future, this type of arrangement would only work if the investors have, good faith and good trust on the platform itself. So you see, there are not many platforms actually running around the market. Yeah, there are some, 5, 10 platforms, maybe 20, 30 platforms that actually are well known, because investors do not invest their money on someone's ideas, especially when they, have anonymity, if they don't trust the platform. So actually they bet on the platform. They bet on the platform that the currency or the promise to issue currency, if it is being offered on, for example, on YY.com, it must have some sort of truthness in itself. So people actually jump in and then they try to, get this type of, even they'll invest in a promise. So initial coin offering involves actually issuing a particular type of coin or a token in the market, or maybe just issuing a promise to give tokens or coins in future. So initial coin offering covers both. Now, just to clear some thoughts about it, I'm definitely sure that you must be wondering that, it is just a website on which someone is actually issuing a currency named YY. Why would an owner come and actually invest in YY? It doesn't make any sense. It does not have legal tender. You see, when you see a physical currency, if it's written £100, it means £100, because that is what the law says. Now, no law is applicable on cryptocurrency. So why would any person come and buy YY currency if there is no legal tender? It cannot be used. It cannot be mandatorily used to buy and sell goods. It does not have any intrinsic value. It does not have any, on anything coming out of it, any good or service coming out of it. Why would anyone invest, money in this particular type of currency? Yeah, you're right. The main reason why actually some people bet on buying cryptocurrencies and selling cryptocurrencies is the algorithm or the code that actually backs cryptocurrency. You see, many people feel that as the world progresses, the internet becomes cheap, the technology becomes cheap, and as the world is innovating and progressing, ultimately people feel that having digital currencies is the future. Even nowadays, if you see, there are less number of people who actually carry physical money with them. Nowadays, you use online banking, and there are QR codes, and then there is Apple Pay, and then there is everything like that. And people nowadays actually don't use physical currencies anymore. They actually use the online medium. So since online medium is becoming very much successful and popular among today's generation, people actually feel that digital currencies have a future. And you know what the thing is? According to the algorithm on which, according to the code, according to the mathematical formula, you can say, on which cryptocurrency is created, the main limitation or the advantage of this algorithm is that scarcity will be followed. Only a fixed number of digital currencies would be made on this, based on this blockchain technology. Now, just think of it. Digital currencies is the future, and there are only limited number of currencies that will ever be issued. By all means, this algorithm has a limitation. It can issue, for example, X million number of coins. So if you feel that something will have automatic value in future and it will be limited in number, as an investor, you would try your level best to acquire that particular digital asset for yourself. So for example, if YY had all the digital currency in the world, and in future when it becomes a mandatory thing and it gets the legal tender because of the advantages that it possesses. It's uncorruptible, it's undeniable, everything is recorded, and there are very less chances of corruption and everything. When it becomes eventually accepted by the global economy, if I have all the coins or majority of the coins, I can demand any value for that, for the against the ownership of that digital currencies. So actually, many people, many investors are betting on cryptocurrencies because they feel that it is going to be scarce in number, and eventually people will come on to accept this type of digital assets and currencies. So it will have much value, and we will earn a lot of capital gain. So there is a lot of demand and supply going on, and that is how digital currencies actually derive their value, right? So a person would be investing in cryptocurrencies if he feels that it is going to be the currency of the future, and it is coming cheap right now. I should acquire it, so I earn a capital gain out of it. So this is the only reason a person would invest in cryptocurrencies. Now it's I believe this is enough knowledge about cryptocurrencies when you are just focusing on your accounting paper. Now, the thing that comes into your mind is that, so how do you do accounting for these type of cryptocurrencies? For example, if an investor buys a YY1 cryptocurrencies, how do you account for it? I mean, is this inventory? Is this a right to use an asset, or is this a financial asset? Is this just like cash or cash equivalent? What is this, right? So the best thing is, or maybe the worst thing is, that there is no specific accounting standard yet developed by IASB which deal with such type of digital currencies, right? So the best thing or the worst thing is that there is no specific accounting standard till date which has been created by International Accounting Standards Board that actually deals with these type of digital assets, meaning cryptocurrency and other type of digital assets. So there is no one accounting standard available. So what does an accountant need to do? As an accountant, in your exam, you should apply your judgment. Where a specific accounting policy or an accounting treatment is not provided by IASB, the accountant has to make sure that it applies judgment, considering the accounting standards that are available and through the writings of the conceptual framework, and then determine the appropriate accounting treatment for them on, for their own use. So there is no one accounting standard available that actually talk about the accounting for digital currencies, how to debit them, how to credit them, how to value them, how to recognize them, what is the derecognition criteria, are they depreciated or not depreciated, or are they mark to marketed or not. There is no particular accounting treatment available. It is an accountant's responsibility to, considering the available accounting standards and the conceptual framework requirements, they should, create their own appropriate accounting policy. Now, since I've just said that the accountant should create the appropriate accounting policy based on judgment, now this means from an examination perspective, you may highlight one or two or maybe three or four accounting standards that may be applicable, right? You can say that this particular accounting standard may be applicable and just talk about the rationale behind it. And you can talk about multiple accounting standards. You can say that, for example, IFRS 9 is applicable from this perspective, or maybe some other accounting standard is applicable from this perspective. So, for example, from the, if we talk about from a stakeholder's point of view, you may say that, holder of the cryptocurrency should do accounting like that. For example, an issuer should do accounting like that. For example, the platform should do accounting like that, right? So you can define many perspectives in an exam and talk about different perspective and convince your examiner that if this is the case, I feel that this accounting should be followed, or if this is the case, this type of accounting should be followed. You can, go it like that way, and most likely you will score good marks if you do it like that. You have to cover the whole aspect of different accounting standards that may be applicable in such a scenario. So don't talk about just one accounting standard. Maybe you can talk about many accounting standards if the examination marks permit. For example, if the cryptocurrencies topic comes for 4 marks, You cannot talk about different accounting standards that may be applicable. You just need to pinpoint whatever data that I'm giving you right now and after this point. And if it comes for example, 10 marks or 12 marks, you may need to explain from different perspectives, right? So just focus on that. Now, how to really account for different type of digital assets actually depend on what is the use of those digital assets. So if we go on to the next page, what possible accounting treatment can be depends on what type of digital asset you are talking about. Now, one thing's for sure, one thing is for very sure, that similar type of cryptographic assets, I mean similar type of digital assets must be accounted for in the same manner. It cannot be such a scenario that, for example, a company buys two types of digital assets and accounts for one type of digital assets in one way, and a similar type of digital asset is accounted in another way. It shouldn't happen. There must be some sort of consistency within your accounting treatments. So what type of accounting treatment you should actually follow for all similar type of digital assets? Now, you should consider two things here, right? The accounting practices require that you consider two things here. What is the primary purpose of the asset? Number one, what is the primary purpose of the asset? I mean, are you actually holding the cryptocurrency or the digital asset just for trading purpose? For example, if your business entails that you will be dealing within cryptocurrency in the ordinary course of business activity, it may look like an inventory for you. For example, if you acquire digital currencies with a long-term perspective, some other accounting treatment may be applicable. If you are issuer, the first time issuer of the cryptocurrency, there may be some other accounting implications that you would have to follow. So the first point is, why are you actually acquiring that particular cryptocurrency? What is the primary purpose of that particular currency? You want to use it as an ordinary business activity, invest it and earn it in the long run? What do you want to actually do? One thing. And the other thing is how the asset, the digital currency that we are talking about, actually derives its value for its holder. The main thing is, how does it create value for the holder? How does the holder or the buyer of the crypto or of the digital asset actually earn out of it? What is the economic benefit derivation for the holder of the digital asset? Now, here, since there can be various types of advantages that a person may acquire from a particular type of digital currency, the digital asset, I may say, I need to talk about different type of digital assets that are currently available in the market. Now, one type of digital asset that is currently available in the market is cryptocurrency in itself, that we have been talking about this whole while. So cryptocurrency is actually a currency. The whole idea behind creating cryptocurrency as a digital asset, using the blockchain technology, is to ultimately in future use it as a currency. So currently it operates independently of central bank, and it should act as a medium of exchange. You should be able to use crypto assets, cryptocurrencies, to buy and sell goods and services. This is the ultimate future. Now, how does cryptocurrency derive its value? What is the purpose of cryptocurrency? To be used as a currency in future. How does it derive value for the holder? Currently, since there is no legal tender available, so currently cryptocurrency only derives its value based on supply and demand. So right now, if for example you hold a Bitcoin with you, right, and for example, if it is valued at $100, say, so why your Bitcoin or your holding of a Bitcoin is valued $100? There is no underlying economic benefit coming out of it. The only reason why your Bitcoin is valued $100 is because it is being traded at $100. The whole valuation actually depends upon demand and supply, right? So which accounting standard to follow actually also depends on that how the particular digital asset is deriving its value, right? Now, next, there are also asset-backed tokens. Asset-backed tokens is basically a securitization relationship. This is basically a securitization relationship, right? So, for example, what does an asset-backed token or a coin mean? It gives the holder representation of ownership of a physical asset. For example, natural resources such as gold or oil. You know, it is basically a securitization relationship. What do you mean by securitization? You know, traditionally what happens, for example, there is a person, I'll just name him YY. I'll just name him, you know, with my prefix. So there is a person YY, and you know, right now what happens is, for example, if I want to buy a particular type of property, right, what will happen? I will go to the property dealer or maybe a seller, and I will make an agreement with him, a physical agreement with him, and I will, you know, actually create a trust deed or maybe, you know, a contractual agreement, printed on an affidavit, and that particular affidavit would guarantee that actually I own this property, right? This is what happens nowadays. Now, asset-backed token actually seeks to revolutionize this whole idea. I mean, why should I physically carry the trust deed with me and prove my ownership of a particular property? Now, this trust deed can get stale. It can be destroyed. Why would I actually store a physical trust deed? It can be burned down. It can be, it can be, stolen. So there is a big risk around it. So why do I carry a trust deed? Now, asset-backed securities or asset-backed tokens actually mean that you can, rather than making a physical agreement, what you can do is you can securitize it. You can actually create a digital security, a digital agreement, and then store it online. And since it is on the blockchain technology, it cannot be duplicated or corrupted. So, asset-backed token is a token which proves your ownership of a particular asset, right? So this is what it is. So how does this, for example, if I create a trust deed online in the form of a cryptocurrency or a digital asset, so how would this particular coin or a digital token would actually derive its value? It derives its value based on the value of the underlying asset. I mean, its value is based on property value, right? So this is an asset-backed token, a digital coin that would represent your ownership of a particular property or say any particular asset that you may be talking about. Now, there are certain utility tokens as well. Utility tokens, right? Now, utility tokens are digital tokens, a digital permission or a digital, right that allows you to access a particular product or a service. I mean, it's a simple thing. I mean, just imagine that, you want to use all of my SBR lectures for the purpose of study, right? And I say that, all right, you want to have SBR lectures for the purpose of study, but obviously you'll have to pay for it. So, for example, just taking an example, and I'll take a good example which actually benefits me. For example, you say, sir, I want your SBR lectures for upcoming, June 2022 attempt. So I say, okay, so you have to pay me $1,000, and then I'll give you access to my lectures, right? Access to my lectures. So one thing that is possible is that you give me physical $1,000 and I give you the digital access of a particular service, my lectures. Now, all of this can happen digitally as well. What if you give me some $1,000 and I give you a digital key through which you can access my lectures through a particular platform. Now, basically, this key would be in the form of a token or a coin. I mean, it is just known as a token or a coin. It is not going to be an actual coin. Don't think about it. It is just basically a digital key that I would provide you so that you can access a particular product or a service for a particular time of period. You maybe, utility tokens are maybe they are used in future for my lectures, maybe for Netflix, maybe for YouTube. You would have to buy a digital token in order to access that particular thing for a particular period. Now, how these type of tokens actually derive value? The value of the YY lectures token is $1,000 because the lectures are worth $1,000, right? So the value is derived from the demand of the service of the product. The value of the service is actually the value of the token. Unlike cryptocurrencies, since they don't have legal tender, their whole of their value depends upon demand or supply. But using the same digital concept, we can also create asset-backed tokens and utility tokens, but they will have a definite value, and their value depends upon, upon the value of the product or the service, right? This happens. And then there are also security tokens. Now, security tokens are just like shares. I mean, you call them shares, you call them ordinary shares, preference shares. The new norm, the new name would be security tokens. What are security tokens? Now, security tokens provide you with an economic stake in a legal entity, right? So unlike other cryptocurrencies and other digital assets that we just talked about, if there is a security token, it will give you an economic stake in a legal entity. So this would mean that security token is just like an equity instrument. It is just like a share. It is just like a share. Previously, you used to call it share. Maybe in future you would call it a digital shares token or a security token. It gives you an economic stake in a country, and against that stake, you might receive cash dividends in future or other financial asset of another company. This may happen. So security tokens may look like an equity instrument and be dealt under IFRS 9. How do you derive the value of a security token? Their value is derived from the success of the entity, since the holder of the token shares in future profits or receives cash of another another financial assets. So actually, the company's economic value is the economic value of that particular security token, right? So, these are the third and the fourth type of token digital asset that I want to talk about. Your examiner can give you any type of example that relates to any of these particular type of digital assets. What you need to understand is that any particular coin or token that your examiner talks about, what is the primary purpose of that particular asset? I mean, what does it represent and how it derives its value from the holder, right? Now, if it gives you a physical asset, that coin is a physical asset, right? So in this case, for example, if there is an asset-backed token, this token is nothing but a contract, but an ownership document of a physical asset, right? So you should treat this token in itself as an access to a physical asset. It may be accounted for under IAS 16 or IFRS 16, for example. So if you have a utility token, you might want to treat this utility token by, like a right to use a particular service, right to use an asset or something, right? You may want to go into IFRS 16. If you have a security token, you might want to deal it like an equity instrument and go under IFRS 9. So what is the primary purpose of that particular token? It gives you equity. And how does it derive its value? It derives its value from the company in itself. So it should be treated as an equity instrument. So you might want to apply IFRS 9. Now, this gives you the question that, okay, asset-backed token and utility tokens may be treated under IAS 16 or IFRS 16. I don't know, because there is no particular crystal clear application about it. And security tokens may be dealt under IFRS 9. So this brings me to back to the question that how to deal with cryptocurrencies, how to do accounting from cryptocurrencies. Now, they seem like currency, they seem like cash and cash equivalent, just like any other currencies, but just present, digitally. They seem like cash and cash equivalents, but they are not cash and cash equivalents. You might think that these may be treated as financial assets, right? These are just like online bank or, a right to receive cash, because if you have a cryptocurrency, you will automatically get some money out of it. But I think it doesn't have any right to receive cash. You might want to think that, cryptocurrencies may be dealt as an intangible assets just because they are intangible. So there are various ideas coming into your mind. So despite the fact that there is no particular one accounting standard applicable, but what the world has actually thought about in the meanwhile, I'm going to just discuss, those ideas with you. Now, many people have commented that cryptocurrencies or these type of digital assets, I'm talking from the holder's perspective, if you buy a digital currency, right? So many people think that, digital currencies like cryptocurrency can be dealt according to one of the following accounting standards. They may be dealt under IAS 7 as cash and cash equivalents, be a part of the cash flow, be a part of the current assets balance sheet, right? Some people say that, okay, these are not actually cash, but it is a right to receive cash. If you have, for example, if you have a Bitcoin worth $100, you can actually sell it and get cash out of it. So it's a right to receive cash. Some people say that it may be treated under IFRS 9. Some people say, okay, if you have a cryptocurrency, if you have a currency, you may get the right to use the platform, or you may get the right to acquire something or use something. It may be treated under IFRS 16. And as I just said, some people say that it should be treated under IAS 38. So what the world says, I'm just going to discuss it with you. You see, cryptocurrencies, as far as cryptocurrency is concerned, these do not have legal tender. A legal tender is a legally recognized payment instrument. So for example, if I have a Pak Rupee note, that Pak Rupee note is worth something because the law which is applicable in my country allows that particular piece of paper to be used as an exchange, as a medium of exchange. So since Pak Rupee has a legal tender from the local government, it is valued as cash and cash equivalent. But right now, cryptocurrency does not have legal tender. Now, I really want to clarify it here because some of the people may have some issues with this concept. So you see, cryptocurrency does not have legal tender. It does not have legal tender. It does not have any legal right to be treated as a medium of exchanging goods or services. No, it does not have legal tender. While some companies in the world may allow you to use digital currencies as a means of payment. All of you might have heard that some Starbucks coffee shops and some other countries and some other companies have allowed digital currencies as a means of payment. Even I heard that Tesla allows cryptocurrencies as a means of exchange to get their car. Although some people may accept cryptocurrencies as payment, but they don't have the requirement to do so. Since cryptocurrency does not have legal tender, they don't have the requirement to do so. So legal tender is more of a requirement. It's more of a requirement rather than a choice, right? So since, again, cryptocurrency does not have the requirement to be used, it does not have legal tender yet, it cannot be treated as cash and cash equivalents right now. It cannot be treated as cash and cash equivalents right now because it does not have legal tender. Some companies may accept cryptocurrencies as a means of payment, but however, they don't have the requirement to do so. And furthermore thing, that IS 7 says that cash and cash equivalents represents anything whose value, there is no risk of significant changes in value. I mean, cash and cash equivalent. IS 7 does not define cash and cash equivalent as euro, pound, or dollar. It says it is a mode of currency. It is something which has a stagnant value. It does not have a risk of significant changes in value, and that is termed as a cash and cash equivalent. But for cryptocurrencies, since cryptocurrency's value is just based on demand and supply, there is a big risk of changes in value. We have seen in past that cryptocurrency markets go down, go up, and they move drastically. So right now, since they don't have a fixed value or a determinant value, or I may say they have a significant risk of changes in value, it cannot be treated under IS 7 because it does not comply with the accounting standards requirements. So cryptocurrency is not IS 7 cash and cash equivalent. So sir, it must be IFRS 9's financial asset. I would say no, because crypto does not provide you a contractual right to receive a financial instrument. I mean, yeah, you may say that, for example, sir, if I buy a Bitcoin worth $100, when I go to a platform, I would be able to sell this Bitcoin for $100, and in exchange, I would get cash, $100 cash in my bank account. But you see, there is not a contractual right that you will get $100. It is just it can be just a matter of seconds that this particular coin turns down to the value 0, and then you have no right to receive cash. All right. So there is a no contractual right to receive cash, which is a pertinent requirement of IFRS 9. So it does not come within the scope of IFRS 9 financial assets. And moreover, cryptocurrencies does not actually form as an equity instrument. Cryptocurrencies in particular, cryptocurrencies is not an equity instrument either, because it does not entitle you towards the residual interest in the net assets of a company. So neither it gives you a contractual right to receive cash, nor it provides you a stake in the issuer's company or the platform's IT company, so to say. So therefore, it cannot be, it cannot be categorized under IFRS 9 as well. Now you would say, for example, sir, if it is a security coin or a security token, as we discussed right here, now that can be dealt under IFRS 9. You're right. But here in this particular slide, I'm just talking about cryptocurrencies. So cryptocurrencies whose value actually depend upon demand and supply, it does not have legal tender. It does not entitle you towards a right in the company, in the equity stake of the company. It cannot be dealt with in IFRS 9 as well, most likely. If we talk about IFRS 16, what can be the implications of using IFRS 16? I mean, token holder is provided with the right to use. Once you buy a token, you have the right to use that token on a particular platform. Thus, you have the right to control. You can choose how and for what purpose you use that particular token, right? But I often feel that other requirements of being classified as a leased asset does is not present here. We studied in embedded leases or IFRS 16 that there are 4 conditions that must be met in order to classify a contract or an arrangement as a lease. Now there is an identified asset, and when you buy a cryptocurrency, you have the control over it. But you see, the period of use is actually missing. The period of use is actually infinite. If you buy a cryptocurrency, you can use it for an infinite period, and you don't have to pay on regular intervals. There is no actual regular consideration involved. And you see, all of the risk and rewards are transferred to the buyer as soon as you buy that particular type of currency. So for example, if you are an issuer, if you are an IT company and you develop a particular type of cryptocurrency, you actually coded that cryptocurrency, and for example, you sell it to a particular buyer, all of the risks associated and the rewards associated with this particular type of Bitcoin goes to the buyer immediately. And nowadays it rapidly changes hands. You would sell it to someone else, and this one person would sell it to someone else, and so on and so forth. So you see, then the risk and rewards are interchangeable many a times, and the asset is not going to be returned to the original party anytime. You may say that this type of arrangement should not be classified under leases, right? This should not be classified under leases. It is not a leased asset, so to say. So what are we talking about? Options do we have left now? Yes, majority of the practitioners right now have agreed upon following intangible assets, IS 38, for classifying, measuring, and accounting for these type of digital assets. Now, how does IS 38 define intangible assets? It defines an intangible asset as any asset. I mean, you should control that asset. Identifiable, which is non-monetary, without any physical substance, meaning being intangible in nature, and it is identifiable. The core thing, if you have studied IS 38 from me, you would remember the main thing is identifiability. No, many of the practitioners have actually come up to the conclusion that cryptocurrencies are identifiable. That is, they can be easily sold. They can be easily sold or valued, separate from the entity. If an entity actually, if for example, if a platform company or an IT company develops a cryptocurrency, a Bitcoin, they actually code mine a particular currency, they can sell that particular Bitcoin independent of that entity. So for example, this type of IT company may have $100 million valuation of that particular company on its own, and they can easily sell Bitcoin at $10's value, because it is a product of that particular issuer, not the company in itself. You can easily separately sell and value that type of particular cryptocurrency independent of what the company is worth or what the company is doing. So actually it is identifiable. It is identifiable. It's not non-monetary. It's non-monetary. It's an asset, right? It is without any physical substance. So people say that it should be classified under IS 38. Now, when you do follow the people, and based on your own judgment, you classify it under IS 38, you need to follow what IS 38 says. So if you classify it as an intangible asset, IS 38 has two measurement models under its under the standard: cost model or revaluation model. So you need to remember that most likely revaluation model would be applied for intangible assets, these type of intangible assets, right? Because a cryptocurrency actually derives its value based on demand and supply, based on the trading volumes it has on that particular digital platform. So definitely it should be carried according to a market model. So most people would say that, okay, in order to seek fair presentation, we would go for the revaluation model. But remember, if you follow revaluation model, and if revaluation model is applied on one asset, then it should be applied to all assets of the same class. So for example, you may buy different type of cryptocurrencies. You may buy Bitcoins, you may buy Ethereum, you may buy YY coin, you may buy XY coin, you may buy XYZ coin, you may buy different type of coins. But all those coins should be measured under the same model, and that is revaluation model. And now, when you follow revaluation model, any increase in value will go into OCI and accumulated under revaluation reserve. And similarly, a decrease in value would result in having P&L. It would be very easy, I would say, to determine the market value of these type of cryptocurrency as intangible assets, because an active market would always be available. Most likely it would always be available. And so you would be following the level 1 of IFRS 13 in order to measure these type of digital assets. In order to calculate the fair value of these type of digital assets, you would be using the quoted price on active exchange, and use it as the basis for fair value, right? So it is, see, you see the implications of IFRS 13 as well. One thing, you have to follow IAS 38, and then one thing more that you should follow for fair presentation. You should follow the revaluation model. If you follow the revaluation model, there you need to calculate the market value, and that market value should be calculated as per IFRS 13. IFRS 13 has categorized the levels that you should use in order to calculate fair value. Active quoted prices is level 1, and you should be using that particular level in order to measure up your crypto assets. Most likely, one more implication of following IAS 38 is that most likely these type of digital assets or cryptocurrencies is going to have indefinite useful life. Yeah, I mean, you cannot determine the life of a Bitcoin. Nobody knows. I mean, it can go off tomorrow. It can, at least from the holders or the buyers point of view, they believe that it will stay forever. So it has indefinite useful life. You cannot determine its useful life, really, right? And therefore there will be no amortization applicable. While there will be no amortization applicable, you need to consider that annual impairment test will be mandatory. So far so good. Many of the people say that when you buy cryptocurrency, when a company buys cryptocurrencies, when Tesla bought cryptocurrency, the most appropriate treatment, not according to me, but many of the practitioners, they say they should be treated under IAS 38, right? And you don't only need to know that IAS 38 should be applicable. If the marks allow you, you also need to comment on why a particular accounting standard would not be applicable. So why IAS 7 is not applicable, why IFRS is not applicable, why IFRS 16 would not be applicable, and why IAS 38 would be applicable. You need to talk from various perspectives in order to gain the required marks, right? So, even on a macro level, you should discuss various accounting standards and their implications. At least 5 accounting standards, or maybe 6 if you include impairment testing as well. These have been considered here, right? So 4 accounting standards here, IFRS 13, and maybe the implications of impairment, IAS 36 is being talked about here, right? Adding on to this, if an entity holds crypto coins or tokens for sale in the ordinary course of business, for example, you are a platform or an IT company which has the job of issuing, which has the job, ordinary business activity of issuing different type of cryptocurrencies by coding, developing, and issuing different type of cryptocurrencies, then for you, IAS 2 inventory should be the most appropriate accounting standard. You would not go in IAS 38 most likely, but you will go into inventories, the exchange, the platform, the fund that actually issues cryptocurrencies or actually stores, buys, and sell cryptocurrencies in the ordinary course of business would be using IAS 2 inventories, right? Further, following IAS 1, you should provide a disclosure outlining your judgments and your estimates that you have taken while deciding on what accounting treatment should be applicable when you hold a particular type of cryptocurrency, and how you have calculated its market value, how you have calculated, you have actually measured that particular type of coin or token. IAS 1's implication is also there. So many accounting standards that we have discussed, you need to know them all. So overall, 8 accounting standards have an implication when you're dealing with these type of digital assets, right? Good. All right. So now moving on to topic number 2, also a digital asset. And now I'm going to talk about NFTs. Now, NFTs is also the new thing around here. NFTs are known as non-fungible tokens, and they are also an example of digital assets. So I presume that since we are talking about digital assets and cryptocurrency up to a certain extent have already been tested in your exam in the previous attempt. So I feel that your examiner may try to, play a bit with you guys, and, rather than asking for cryptocurrencies, it may ask you for a non-fungible token or an NFT, which literally has the same accounting treatment as cryptocurrency. But since you would be unaware of NFTs, your examiner would get an advantage out of it, or maybe, just challenge you in an exam. So what are NFTs, or what are non-fungible tokens? The first thing, we are talking about tokens or coins. So token or a coin is a digital asset issued by a particular platform, right? So we have the basics right now. But what do you mean by non-fungible? So non-fungible actually means non-interchangeable, non-interchangeable. So this time, when you talk about an NFT coin or an NFT token, it is not interchangeable. For example, if you had cryptocurrency, if you had a Bitcoin, you would be able to exchange one Bitcoin for another Bitcoin. I mean, one Bitcoin is equally relevant, equally valued as compared to another Bitcoin. For example, there are two friends. So one friend bought a Bitcoin from a particular exchange, and then there is another friend who also bought a Bitcoin from, who is in a different country or in a different location, or maybe he bought the Bitcoin from a different exchange. But since these two cryptocurrencies are interchangeable, they have the same value. I mean, person number one can exchange its Bitcoin for person number two's Bitcoin, and it won't make any difference. They are interchangeable tokens or coins. But one thing that you need to know about NFTs, now each and every NFT, each and every token, or each and every coin which is classified as an NFT has a separate value of its own. It has a separate value of its own. So for example, if there is a NFT, this would not be equal to a B NFT. Now, A NFT is entirely something else and B NFT would be entirely something else. So they are non-fungible. They cannot be exchanged with one another because they have different assets that are backing them. They have different logics that that are backing these tokens or coins. These are different type of assets altogether. So they are not interchangeable. So if a person comes and buys A, he gets whole of the rights of A. If a person buys B, he gets whole of the B. It does not happen that you can have an A and I can also have an A. We both can't have it, right? So what is an NFT really? It is non-fungible, we agree with that. Non-interchangeable, we agree with that. But what is an NFT? It is a digital token or a coin that actually represents real world objects. So NFT is basically a digital form, a digital form of a real life physical asset. So for example, the NFTs are generally used for pieces of artwork or music or picture or video, etc. I mean, generally it is used for digital art. So for example, you have created a painting, right? And you want to sell this painting, right? And assuming nowadays you create a painting digitally, you want to sell this painting. So normally what happens is that if you want to sell this painting, you would go to an auction or maybe an art gallery, right? And try to sell off that digital piece of art or that particular painting through that. You would sell it through the art gallery or the auction, right? Now NFT actually makes this transaction more efficient. What NFT's concept says is, for example, if you have a painting, you directly come onto our platform, right? Create a digital form of this painting, create a digital sacred key of this painting, and then sell it digitally, rather than actually involving brokers, dealers, an auctioneer, or maybe an art gallery owner. Just sell it digitally. And if a person buys this sort of painting digitally, he will get a coin, or you can say a key, which actually guarantees the ownership of this digital painting, right? So what actually NFT represents any video or music or art or anything which is actually converted into a digital key, and it is sold online digitally. It makes the process so much easier. Now, one thing that is pretty amazing is that when a person buys a particular type of digital assets by buying a particular type of token, so I just told you that he gets the key, or the actual ownership of that particular asset. It is a sort of a digital contract. You buy a particular painting digitally, and you have the exclusive specific rights of that particular painting. So how does that happen? How do you have the actual exclusive rights of that painting? You will get a unique identification code. So there will be a unique identification code which only you would have, and you can sell it to somebody else, but only you would have that, and therefore you actually own that particular piece of painting. Now, the amazing part is that don't think that the token holder have an actual possession of that physical asset. It is possible that you don't actually physically own that particular physical asset. However, you own the ownership right of that assets, but it may be an art or a video or a picture or a music that everyone has heard of. So for example, let's take an example. For example, if I'm a singer, and you would have guessed through my voice that I'm definitely a singer. I'm just joking. So for example, if I sing a song and I feel that this song is going to make market, I just upload it on YouTube. So many people like my song, many people like the music, like the satisfaction that my songs give them, and it is pretty much valued. Yeah, it's available on YouTube. Everyone can hear. You can hear it on Spotify, you can hear it on Apple Music and everything else. So everyone has heard of that particular song, so it's publicly available. What do? I make NFT of this music, and then I can sell it to a particular investor, and that particular investor would have an exclusive right to that song. So now you would be thinking that, okay, everybody can listen to the song. The song is available with anyone, everyone. It is available on YouTube and so on and so forth. But an investor comes, pays you very much, and takes the ownership of that particular song in the digital format. But what's the point? Why would he be investing in this particular song, even though digitally done? But why would the investor be investing if it's publicly available? Because it may provide the investor, through that unique identification code and through that ownership right, it may provide you the exclusive right to generate further economic benefit later on. So for example, I sang a song, it became very famous on YouTube, and then I made an NFT, a digital code of that particular song, and sold to an investor. And now, for example, there is a film producer who wants to use that song in this particular Bollywood film or a Lollywood film, I would say. So there is a particular film producer who wants to use this song. He will go to that particular investor, and just like how a trademark works, they will pay him the money because he has got the exclusive digital rights of that particular song. They will pay him money and then use the song and that particular film, right? So he may sell that song to a TV channel, a film producer, or maybe any show or something like that, and earn some money out of it. So this is what happens. And same goes for a painting. That painting, everyone may have seen Mona Lisa's painting, But if you make an NFT and you sell it to someone, you know, okay, you can see Mona Lisa all you want. Her picture is available physically in a museum, and you can see it online as well. But I've got the ownership rights of that Mona Lisa painting, and I've got it digitally. So I may give it on rent. I may give it, sometime one time, offer to someone to make it, to use it in a film or something like that. So you know it's good. Okay, so why would an artist be interested in an NFT? Why NFT is talk of the town right now? We just saw Shine Shah Afridi bowling out, an Indian legend in the T20 World Cup in 2021 or sorry 2022, and they said they will create an NFT for it. Why an artist may be considering NFT nowadays? Why is it talk of the town? Because it's much simpler. It's much simpler rather than going on to a media company or a publishing company and selling your song, going to the music director and saying, please just listen to my song and it's great, and so on and so forth. And you don't need to do that right now. If you feel that the feedback is good, your song is good, it's being listen many a times on YouTube or some other platform, you can actually create an NFT and sell it online to the global audience, or to a global investor. You actually filtered out the auctioneers, the art galleries, the exhibitions. You actually filtered out everything. So NFT is pretty much profitable to the artist itself. And it may be an arrangement that artist gets a royalty each and every time this NFT passes on different hands. So if a person, for example, buys an NFT, it may wish to transfer this NFT to another person for that person's sacred ownership of that particular art. And every time the artist can get a royalty out of it, so it can be much more valuable right now. So maybe in future you would see that all the articles that are published, they may be published through NFTs. All the research work may be done through NFTs. Many things are possible when you are following a digital platform. So yes, NFTs is a thing. And why it is becoming more and more important for you guys as students, and why would your examiner want to actually test this particular topic with you, is because NFTs are getting more and more acceptable. People, there are countries and there are jurisdiction in which cryptocurrency, although it is not accepted yet, but NFTs, they feel NFTs, since it is backed by a real artwork, governments are really much acceptable. They are accepting NFTs pretty much. Yes. So even in some governments, you must have heard that they have started taxing capital gains from NFTs. Yeah, and when a person changes hands for a particular NFT, it makes a profit out of it, and many governments have started taxing it. So which means that the government has legally accepted the valuation or the existence of NFTs overall, right? So it's becoming more and more acceptable form of transaction. Where you see the advantages of NFTs, you also need to understand that this world is not beyond scams. Scams are everywhere. So I certainly feel that, or it is happened many a times. If you read some articles or you Google it out, you would see that scams are possible and they have happened. For example, on a particular platform, there is a particular issuer who says, if you buy my NFT, you'll get the exclusive rights of the Mona Lisa painting, or the terrific bowling of Shine Shah Afridi, or maybe a particular song, or maybe a particular clip, or maybe a particular audio. And actually an investor buys that particular token or a coin for X amount of money, and it is not actually the thing that you thought of. Maybe it's a scam. Maybe the other issuer was, he was just faking. So NFTs scams are possible. Now, the platforms that actually allow NFTs to be sold on their website, you know, platforms are, becoming more responsible nowadays. They actually perform due diligence. If a person comes and says that I've created a code which allows a unique identification code in order to get the exclusive rights of a particular song and art or something like that, the platform actually provides due diligence first, and then allows it to be traded on that particular website. So scams are possible, but the platforms are becoming more diligent, because if an investor feels that he is being scammed on a particular website, he won't be coming next time. So the platforms are becoming more and more diligent about this transaction, right? So NFTs anyways is a real thing. So how to do accounting for NFTs? So this is the main point. So you account for NFT just like cryptocurrency. NFTs are accounted for under IS 38, intangible assets, and most likely they'll have an indefinite lifespan, just like trademarks have. And you would do every bit of accounting that is applicable under IS 38. All the things that we just discussed for cryptocurrency as well. So yes, NFTs are for sure. There is no doubt about it, since they represent digital arts most likely. So it is a digital ownership right, and it is most likely an intangible asset, right? How do sellers of NFT account for? Sellers of NFT will account for under IFRS 15, that is revenue from contract with customers. And most likely the accounting would be in the format of point in time. Point in time, because if there is a seller who actually sells the digital right of a particular painting or a music video, your performance obligation is satisfied as and when you provide him the unique identification code. So your performance obligation is satisfied point in time, you should recognize revenue point in time, right? One more drawback of NFTs and cryptocurrency is that it is routinely said that cryptocurrency or NFTs may be used for money laundering. It is currently, I've just heard the news, it is currently being used by Russia, since they are banned from SWIFT due to the Ukraine crisis. They are dealing in cryptocurrency. They are dealing in, since cryptocurrency is not legally regulated, no one government can say that you cannot come on cryptocurrency. That's not the point. It's deregulated. So nobody can say you cannot come on cryptocurrency. Nobody knows if a Russian is actually transacting on the crypto exchange. Nobody knows. It's the identity remains anonymous, and same goes for the NFTs. So NFTs and cryptocurrencies may be used for money laundering, where a same person would be buying and selling a particular piece of art, but you would be transferring some money from one country to another. This is an easy way to do it. So yes, and this is one of the reasons why many countries have still not yet allowed NFTs legally, because they feel that it has scope of corruption or money laundering. So they want to regulate it. If they cannot regulate it, they are not allowing that permanently at the moment, right? Yeah, so it has a drawback. So from your examinations point of view, I certainly feel that talking about digital currencies and NFTs is talk of the town. So I feel if you're going for March, if you're going for June, NFTs or other digital type of assets is going to be talk of the town. It may be tested under ethics question. It may be tested as a current issue. It should be tested. I don't find any reason why it will not be tested. So it should be tested. It is a hot topic, but not the only topic. There are two further topics that are also, I feel that they should be tested as a current issue. And one thing that I am going to talk about is materiality. So materiality, according to my information, it is an examinable issue under these attempts. So I would say that materiality is definitely a hot topic. But I would say that yes, materiality I've already issued a particular video which I made last year for March and June 2021. I was a bit proactive that time, and even though materiality, actually the real issue of materiality wasn't tested in those particular attempts, but considering what was examinable in the upcoming attempts, I actually gave it out a try. And materiality is in detail discussed within that particular lecture. So I would suggest that everyone, it's in Urdu, so you go and watch that particular um, video to get detailed knowledge about that, about the materiality issue. I'm not very much in favor of repeating the whole topic right now, but yes, if you want some detailed knowledge over materiality, it is definitely an examinable topic. If I were you, I won't be leaving this one out. So you can go on to that particular video, and on my YouTube channel, right? It's Yasir Yamin simply. So I would go there and watch that video in Urdu and get a hold of it. For those people who don't understand Urdu, I would just be giving a brief overview of what rest of it. You can obviously get this from a handout. What actually this current issue is all about. You see, the materiality's definition is changed. In past, materiality was related to item or transactions being material, and the definition of material, so to say, was that any information is material if omitting or misstating it could influence the decision of the users. So in past, we used to say that if any information is material, if you don't tell it or if you misstate it, it will affect the decision of users. Now this information is material, it should be reported, it is relevant, and it is relevant information to be reported. But now there is a slight change within the definition of materiality. Now the definition includes any information if it is going to be termed as material if omitting, misstating, or obscuring. I mean, obscuring means to represent an information in an unclear manner. What ISB saw? ISB saw that many people actually, they told each and everything which was to be told. Each and every relevant information was reported within the financial statements, but it was presented in such an obscuring or in an unclear manner that the actual contingency or the actual problem was never communicated to the shareholder, right? So now this is known as the disclosure problem. Sometimes what entities used to do was that they used to disclose a particular information. I mean, if you feel that omitting or misstating that particular information can affect users of the financial statement, that they used to report that particular information, but in a very unclear manner. Either you would report it in a too lengthy basis, so the actual issue is not understood by the investors or the users of the financial statements, or you write it in a too brief manner, and then even your users won't understand what you are actually trying to say. So materiality's definition is updated. Any information is material, and therefore an auditor has to verify that particular information and give an opinion on it. Any information is material if omitting, misstating, or obscuring, meaning that if you present it in an incorrect manner, it will affect the users of the financial statements, is material. Any information which, if either omitted, misstated, or obscured, is material. So an auditor has to really check on these types of material information. An auditor has to make sure that he gives in an opinion on these types of material information, and the accountant has the responsibility. The people who are charged with governance have the responsibility to present all those material information. Not only the information that if misstated or omitted would have an issue, even if told unclearly they would have an issue. The board of directors need to make sure that these material information are presented in such a manner that it provides useful information to the primary users of your financial statement, right? So you need to think about, or you need to also think about the fact that information needs to be presented and also in a clear manner. You cannot avoid, the clarity of the content here, right? And your examiner also wants to highlight an important area here, and that is that you need to see that materiality is always pervasive in nature. You understand what is pervasive? It has a nature of spreading, right? So you don't see materiality with the lens of a particular transaction. You don't actually see materiality with the lens of a particular transaction. A particular transaction may look, if not faithfully represented, it may look immaterial to you because it is such a low value transaction, but it can have a pervasive effect. It can have a spreading effect. If that particular transaction is not reported in an appropriate manner, the whole financial statements can cast it out. For example, I mean, you talk about cryptocurrency. For example, there is a particular company which only invested $100,000 or maybe only $1 million in cryptocurrency, and you feel that $1 million is nothing for that particular type of company, and therefore, even if IS 38 is not followed or the particular accounting standard is not followed, it won't have a material impact because it is of such low value. And despite the fact, even if it is not correctly accounted for, actually I am reporting it, right? I may report it in the wrong head, but at least I'm reporting it. But you see, if you don't actually report that particular type of investment in cryptocurrency in a right manner, it can cast a pervasive effect and cast a doubt on your whole financial statements as a whole, right? So people need to understand that a transaction may be escalated by creating a doubt on the whole financial statement, and that is just not acceptable. That is just not acceptable. So materiality should be seen with a broader lens. And the practice statement, the current issue document in which this idea was published by ISB, actually outlined the 4-step process in order to deal with materiality issues. First, there is a transaction level step in which you identify a transaction that, if misstated, omitted, or unclearly presented, meaning obscured, may raise an issue. You may consider existing IFRS and say that, okay, this transaction, if it is not particularly accounted for, it may have an issue. Then you should see, as a step number 2, you should see the quantitative and the qualitative aspects of that particular transaction. Now, quantitative means you see the transaction's value in money terms, and qualitative means that you see the transaction's value in nature terms. You see, the higher risk, the higher qualitative risk that a transaction may have, lower is the value, lower is the importance of quantitative. Means even if a transaction is of low value, but the nature of the transaction is critical to the information, is critical to the decision of the users of the financial statements. Even if it is a low value transaction, you should report it, because the qualitative factor actually overrides or actually takes up the quantitative factor. So qualitative factors are more important than quantitative factors. They are equally important up to a certain state, but as the qualitative need or the qualitative aspect progresses, the quantitative aspect lowers down, and then the values doesn't matter. Number 1, you identify a transaction which, if not reported, will have an issue, or if unclearly reported, will have an issue. You create the quantitative, and determine, you assess the material aspects of it, quantitative and qualitative. In the next step, you organize that particular thing in your draft financial statements in a manner that supports clear and concise communication. You take your judgment, you make a judgment that I want to report the cryptocurrency in according to an intangible asset in the non-current assets of the financial statements. You do that. And then as a step number 4, you actually have an overview of the FS level overall. So first you identify a transaction, consider its materiality level. If it's material, you go on to report that particular transaction as per best of your knowledge and the applicable accounting standards based on your best judgment. And then you take a look at on the financial statements as a whole, and you see that are they creating the true representation of to the users of the financial statements as a whole or not. Do you really see the value to the users of the financial statements to look from their perspective, that are the FS looking are the financial statements looking logical or not? And then you finally move on. So you take care of the transaction individually, and you also take care of the transaction on an FS level when you see that particular transaction along with all other account balances that are present on your balance sheet or maybe your income statement, and then you decide if it looks logical or not, right? So materiality is important. You see, materiality matters when there is not a prescribed accounting treatment available, or you feel that the prescribed accounting treatment is not up to the mark, or it may create misrepresentation. If an accounting standard is available for a particular accounting treatment, then there is no argument. Most likely that particular accounting treatment would be correct, and then there will be no argument. The correct accounting treatment would automatically be followed by applying that particular accounting standard. But it makes a difference when, just like cryptocurrencies or whatever we studied, it makes a difference when, a particular accounting treatment is not up to the mark, or you feel that it's not whole truth, or it's not faithfully representing, or in case if it's not available, then materiality matters the most. And then you have to follow this 4-step approach. What I would recommend is that you keenly learn on the definitions and the 4-step approach and all of this page for your examination, because if it comes, you should make sure that you should just bang it and score as many marks as you can. Materiality is important for you guys. One more area that should be important to you guys is about management commentary. Okay, so what is the idea behind the concept of management commentary? ISB feels that numbers and disclosures alone cannot help users of financial statement understand everything. Although you make financial statements and you form disclosures, but ISB feels that just giving out disclosures and just giving out many of the numbers, income statement, balance sheet, there is a risk that people may not actually understand what you're trying to say, or they may interpret the numbers incorrectly, or the financial statements in itself become too complex for people to understand. And that is why many regulators and the ISB itself is actually promoting companies to provide management commentary. It should be a narrative, it should be a descriptive report alongside the financial statements that particularly provides commentary on an entity's prospects and other information which is not explicitly mentioned within the financial statements. I mean, you should talk about the market structure. I mean, you should talk about market pricing. You should talk about competition. Competition is nowhere present in disclosures, but it is important information. You should talk about business risks and the opportunities that you have. Opportunities. You should give a narrative statement. It should be given by the management. It should be given by the directors. And you should talk about the areas of concern that that a shareholder would have out of a company. This should be alongside the financial statements. Numbers are important, but the overall scenario, the market picture, the bigger picture is also important. So there is a draft document, or you may say a best practice document published by ISB. Hey, remember, it is a non-binding document. It is just a guidance document. It is just a guidance document which guides companies on what to talk about in management commentary and whatnot. I mean, I don't want you to make a newspaper. I don't want you to write so much of irrelevant information that actually your users don't use. And I don't want you to be brief with your narrative report. ISB says, I don't want you to write just 2 lines and say that, okay, we have done so much and, just the good parts and skipping up the bad parts. Don't do that. It's not an appraisal document. IFRS says that, a practice statement should include a management commentary that, comments on various aspects of the business. For example, it should talk about what is the nature of the business, what you are doing currently, what you can do, what is actually the business. You should talk about the management's objectives and strategies that are nowhere, covered within the financial statements. You talk about the objectives and strategies which the director have, and talk about with truthness. Tell the people, okay, so we are a traditional manufacturing company right now, but we want to become an innovative technology company in the future. For example, we have been dealing, in this type of markets lately, and now we want to do this. Give out your objectives and strategies so that people know the concept behind the numbers, that why numbers are such, which they see in the financial statements. Talk about your most significant resources and the risks and the relationship that you have with your suppliers, with your customers, with other competitors, and so on and so forth, with the government, with the tax authorities, with the associations, and so on and so forth. Talk about these areas, right? And talk about your results of operations and prospects. I mean, talk about ROAS. You can talk about return on equities. You can talk about other ratios or APMs. You talk about those as well. So why do you want to focus or require your user of the financial statement to apply a ratio himself? You should do it for him, and give out the positives and negatives in the economic results that you have just posted. Tell your user of the financial statement what are the critical performance measures and indicators on which your performance should be assessed. I mean, should it be assessed based on EBITDA, or should it be assessed based on anything else? So just focus it. Go and tell them that, don't measure our performance based on EPS. Maybe measure our performance based on EBITDA. EBITDA may be more relevant, because depreciation and amortization is not a cash expense. You should appraise our performance based on EBITDA. You can say that, right? So management commentary, overall, it is a non-binding guidance document. It is a narrative report that has to be reported alongside the financial statements, so that it provides your primary users of financial statements much more information about the business. And you should be learning these 5 things as well, right? So digital assets, materiality important, and management commentary is absolutely important, I believe, for this attempt, among all other information that you may have got through technical articles or through any other things that we discussed in our regular classes and everything else. These 3 things, I believe, should be an add-on. Now, here I would also want you to have a fair bit of idea, right? I want to be very much honest with you. There is no guarantee that these 3 topics will only come into your exam. Right? There is no guarantee. But you have to use your common sense when you are in your exam. All of the things that your examiner is going to question will somehow be part of your existing knowledge or your common sense. So rather than just foregoing the requirement or foregoing the question and giving out your examination and just failing out in it, you should try your best by adding or making an answer out of whatever you know. So I always say to my students, if a requirement comes into your examination that you don't know the answer of, and you have time to complete the whole paper. I mean, just think about it that, for example, if you were creating an accounting standard or an accounting treatment, what would you recommend? What would you recommend? And anything that then comes into your mind, you just go and write it in your examination. That is what your examiner requires. He doesn't want a perfect answer, but he just wants to see that can you use your brain or not? Do you have basic ideas of the current issues that are prevailing in the society? Yes or no? If you can write a bit for it, he'll give you the whole marks, I'm pretty sure. So overall, this is the thing which is important. Okay. So go through this document. You can just give me a WhatsApp and I'll give you this, document as well, in the PDF form. And I hope it helps you in your examination. It is a very brief document. You should carefully, run through it, go through it 3 or 4 times, and just wish that anything from what we study right now, it comes into your examination, right? I'll be very happy to help you in any case in which I can. So just feel free to talk to me whenever on my WhatsApp number, which is given on the slide. And hopefully, this whole of this lecture, although lengthy, but it will be helpful for you. Thank you very much. Take care. Allah Hafiz.